across geographies. That is what we mean by business restructuring. So in that sense, this is a little different from a merger or a demerger or whatever. These are changes that happen in an organization because of which value gets shifted. Now, this, when it happens, it may result in transfer of intangible assets. So sometimes intangible assets are owned by a company, and as a part of this exercise, they may get migrated somewhere else. Okay. It may happen in the form of transfer of entrepreneurial functions. So in transfer pricing, we can have functions which are regarded as routine functions, and then there are entrepreneurial functions. So in a business restructuring exercise, sometimes you can see that entrepreneurial functions are getting transferred out. And sometimes you can even see existing contracts being terminated or substantially renegotiated. So let's take an example. You have a distributor in India. Let's say that distributor is earning a 15% margin. And one fine day, the parent company says that, oh, how can you earn 15% as a distributor? You should just earn 3%. So they change the margin percentage mentioned in the distribution agreement. Now that's a substantial renegotiation. Is that something which is arm's length? Should the distributor get rewarded in the form of a one-time compensation when that happens? Those are the kind of issues that we deal with. We often see situations where clients come back to us and say that, okay, here is an Indian company which is positioned as a licensee for the Indian market. The licensee is earning, let's say, a 16% margin in India because of Indian business operations. Why don't we terminate the license of this company and then set up a new company and give the new company a license, and then we will structure that new company in such a way that to begin with it earns a 5% margin. Now again, that's an example, which is in the nature of a substantial renegotiation of a termination of an existing agreement, which is also covered within the ambit of transfer pricing. So when OECD deals with business restructuring, it essentially tries to cover these kind of arrangements, where you're trying to redeploy functions, assets, and risks across the border, and in that attempt, you're trying to move value. Now that does not mean that these kind of transactions happen necessarily to avoid tax. And sometimes these things can happen for very, very genuine, bona fide business reasons. So I'll give you examples. There was a multinational enterprise. I will not give you the name here, but this is a case which was actually reported, not through professional journals or whatever, but the company itself at Suomoto reported this restructuring in its through press releases way back in 2001. So this was a company which had grown organically, and then they realized one fine day that they were so large that they had pockets of decision making in different parts of the world. So you had CEOs in Europe taking their own decisions for their market. They had business heads in Asia that were taking their own decisions. And as a result of that, the operations were being conducted in a very discoordinated manner. And this organization realized that they were losing market share to their competition. And one of the key reasons why that was happening is because the decentralized way of decision making was actually slowing things down. Okay. So they decided to change all of that. So they said that, okay, why not create 3 entities or 3 zones in the world where all the decision making will be centralized, and those zones will be the head and brains for those respective regions. So they created a principal entity in Switzerland, they created another principal entity in Singapore, and then those entities housed the strategic decision making for that entire region. And obviously when decision making is housed over there, then obviously that entity should also be responsible for the outcome of that decision making, which essentially means that when intercompany agreements are entered into, the risks of business should automatically get allocated to that entity where the decision making is. And they publicized this restructuring as well in a very transparent way, that they said that, look, this is what is happening, we are losing market share, and now we want to centrally reorganize. So that's an example where, for bona fide business reasons, they decided to do this. And obviously, when this kind of thing happens, it involves a business change. So it involves a migration of a function. So you may have, let's say, an entity in UK which is positioned as a licensee, but then after this restructuring, management control and management decision making has to actually shift from UK to Switzerland. Okay. So there can be many reasons for restructuring, maximizing synergies, economies of scale, improving efficiencies in supply chain. So not to say that these kind of things actually happen all the time for avoidance of taxes. Sometimes they do happen in that way, but not always in that way. Now, when these kind of things actually happen, you will often see, though not necessarily, that there will be a shift in the profitability of different companies in the value chain. Sometimes profits will go up, sometimes profits will go down. And that's the reason why tax authorities around the world are significantly concerned about these kind of transactions, because these transactions being internal to the organization, they often do not come to the limelight, and tax authorities want to ensure that when value does get shifted across borders, should the company which is giving up that value, should it get compensated in some form for giving up that value, in the form of, let's say, a one-time compensation. So what can be the examples of a business restructuring? These are just illustrations, so you can have many diverse situations in which these kind of transactions can occur. But let's say, for example, you have a manufacturing plant in India, and that manufacturing plant is positioned as a contract manufacturer. So this plant has no domestic sales. All that it manufactures, it supplies to its headquarters outside India. Okay. One fine day, the headquarters says that India is becoming too expensive, costs are increasing, so we will shift this manufacturing plant from India to Philippines to save costs. Is there really a restructuring here? These functions are getting shifted. If this happens, where the Indian plant is effectively closed, and then you shift this to some other country, is there a tax consequence? Should India get rewarded in some way? Because it is giving up value in some form. You can have a situation where in India you may have a full risk manufacturing entity or a full risk distribution entity, and then it's sought to be converted into a low risk operation. So the parent company says that, okay, you were assuming lots of risks, your returns therefore fluctuated because you were assuming those risks. And now we want to change the operating model. So going forward, you will not bear all these risks. Okay, the risks will belong to the parent company. You will effectively be compensated with a steady return. So let's assume, for discussion's sake, your returns previously fluctuated from -10 to +20. But going forward, you will get a steady return of 5%. So all the risks are taken out. Okay, so that could be one example. You could have examples where distribution entities are converted into agents. Okay, and therefore, as an agent would generally not bear the inventory risks and trade risks, and consequently, the return that is offered to tax in India will go down. Sometimes you can have different forms of transactions where functions are being centralized. So let's assume back office functions around the world are being undertaken in all the countries. And the group suddenly thinks that it's inefficient or uneconomical to do that. Why duplicate resources in all the 100 countries? So they decide to centralize back office functions in one country. So in around the world, different countries, they stop doing those back office functions and capabilities are created in a new geography where those functions are undertaken. Sometimes there are employee secondments, and sometimes there are workforce transfers. And here I mean, the entire workforce is transferred out as part of an organization. Whether these create transfer pricing consequences, these are not, the last bullet is not necessarily an example of a business restructuring exercise, though transfer of a workforce can happen as an outcome of a business restructuring exercise. In fact, if you see the definition of intangible assets that they added in budget 2012, workforce was added as an intangible in that definition. So how does the OECD really look at this? Okay. As I mentioned to you, OECD issued its final report in July 2010 on business restructuring. And then those observations were then brought into the OECD guidelines formally in the form of Chapter 9. So OECD actually looks at this into 4 baskets: special consideration for risks, arm's length compensation for restructuring itself, which is the point on one-time compensation that I talked about, remuneration for post-restructuring transactions. So once the restructuring has actually been completed, and then you have a new business model that evolves, how do you reward different transactions in that business model? And then the last box is extremely important, which goes to explain in what circumstances actual transactions should be respected and not disregarded. So this is about decharacterization versus repricing. When do you reprice a transaction as opposed to completely recharacterize a transaction? We have the equivalent of a 4 box in the form of a proposed GAR, where the tax authorities have the power to recharacterize transactions completely, which basically means just redraw the lines in the boxes completely. So there are principles on, international principles on in what circumstances that's desirable and in what circumstances tax authorities should avoid doing that. Okay. Let's look at special considerations for risks. Now, why is risk allocation important? Now, what I'm going to do in the next 1 hour or so is take you through various principles here, and we will give examples as we go along, so that you are able to hypothesize in your mind the different situations that can arise. So why is risk allocation very important? Now, usually in the open market, the assumption of higher risk is usually rewarded through an increase in the expected return. Okay. So if a party is seen to be assuming a higher risk, then the mechanism, the transfer pricing mechanism in place has to be devised in such a way that that party has the ability to earn a higher return. That does not necessarily mean that its return will actually be higher. Because if you're assuming a risk, it may be the case that you may not earn any return at all. So here, what is important is that the transfer pricing mechanism in place should give you the ability to earn an appropriate reward for the higher risks that you assume. Okay, that reward may or may not be realized because it depends on business conditions. But arm's length would require that that company should have the ability to earn that higher reward. And when you do undertake business restructuring transactions, as I mentioned earlier, sometimes risk allocations will differ. So a full risk distributor is getting converted into a low risk distributor. So there is a migration of a risk. An entrepreneurial exporter of goods is getting converted into a toll manufacturer or a contract manufacturer. Again, what is happening is the level of risk that the exporter assumes is effectively getting stripped out. And that's the reason why OECD has actually allocated a full section in the guidelines on considerations for risks. So OECD says that the review of risk in terms of what's the risk that is getting migrated out in a given arrangement, it should essentially start from review of the contract that is entered into by the enterprises. Although OECD also says that contracts that are entered into between related parties, indeed they have to be themselves, the contracts themselves have to be structured in an arm's length way, because the diversity or the divergence of interest sometimes may not exist between related parties the way it would exist between third party arrangements. But that may not be the case in related party arrangements. So, but still the starting point of the inquiry should be how the contract between the parties is actually being worded. What that means is that the contract should generally define who bears what risk, and as a consequence of bearing that risk, how that entity would stand to be rewarded through the contract. In general, tax authorities may challenge the allocation of risks between two parties in a scenario where the allocation of risks is not consistent with the economic substance of the transaction. Now, what do we really mean by this? What do we mean by allocation of risk is not consistent with the economic substance of the transaction? Let's look into that. To judge whether the allocation of risk is not consistent with the economic substance of the transaction, one should usually look at comparables. So if in real life you can find comparable arrangements where entities seem to be behaving in a certain way, then automatically it means that yes, that behavior is not irrational, and therefore it can be reasonably expected to be also undertaken between related parties. So you try and hypothesize with reference to third-party comparables. Okay. Now, very often in real life, you will not find third-party comparables for a large variety of transactions that happen between related parties. So let's take the example of a low-risk distributor. A low-risk distributor model, you will never see between third parties, ever. Okay. But does that mean that that's a model which is designed to avoid tax? No, not necessarily. All right. So how do you therefore say that this low-risk distribution model, which is supposed to be or proposed to be entered into, is not an invalid transaction? Now here at PwC, in the network, we had done significant amount of empirical research to figure out that while in real life, low-risk distributors may not really exist, but there is significant evidence available in the public domain to show that distributors sometimes undertake decisions that try to reduce the risk that they assume. Okay, so every entrepreneur, in an effort to maximize return, is also trying to undertake steps to minimize risk, and we tried to demonstrate that to empirical evidence. So while we could not find real-life arrangements between third parties where distribution entities were, let's say, positioned as low-risk distributors, but we did find instances where companies were undertaking steps to reduce the amount of risks that they carry. Okay. So therefore, how does one really approach this? That if you do not find comparables which show that a certain behavior would usually be undertaken between third parties, then does that necessarily mean that the arrangement is non-arm's length? No, not so. In such cases, one should hypothesize that is this a transaction that would be generally be expected to be undertaken between independent third parties under comparable circumstances. Okay. Now that gets into understanding which is the party that has control over risk, and we'll get into what do we mean by control over risk, and whether that party which is assuming that risk, whether it has the financial capability to bear that risk. Okay. Now what does this mean? What do you mean by control over risks? Control over risk essentially means that the significant decisions which create that risk, if a party seem to be assuming those decisions, then the risks which are created on account of those decisions will also be allocated to the same party. So for example, if you are a low-risk distributor in India, and that low-risk distributor is actually taking decisions to launch products in the Indian market. Now, a product launch decision is a significantly risky decision. That launch may or may not work. That product may or may not run in the Indian market. And that launch decision is usually accompanied by significant investments that are required to be made in the market to promote that product. So the entrepreneurial decision over here is the decision to launch the product. If that decision resides in India, then by no stretch of imagination you can call that entity a low-risk distributor, because the function is inherently risky. Then you cannot have a distribution contract written up which says that from today onwards you will not bear any risks and the risks are borne by the parent company. So here is a question of misalignment between the undertaking of a function and the risks which are allocated to that entity under a contract. But you will see these kind of things happen very frequently in real life, sometimes intentionally and sometimes unintentionally. So I'll give you an example. The way most MNCs really operate is that around the world, local entities are generally not assigned significant decision-making authority. So you will not be surprised to see a company where there's a new company in India. That new company is thinly staffed, and it's the foreign company that mostly takes the decisions relating to the Indian market, including decisions of product launches, including decisions of financial and capital investments and so on. But what happens in real life is that, let's say if that decision pays off, and let's say that Indian company is highly profitable, that profit gets trapped in the Indian company. And there is actually no way to reward the foreign company which actually took that decision which created that profit in the first place. Conversely, if the decision fails, okay, and the Indian company actually makes a lot of losses, then transfer pricing principles would require that those losses should go to the foreign company which actually took that decision which created those losses. Okay, and these are misalignments that we see so many times in real life. There are no easy answers to deal with these kind of situations, and today multinationals are trying to put in place structures where if significant decision making resides outside of India, okay, and India's functions are, let's assume, effectively execution of that decision making, then India should effectively be rewarded with a routine return which is commensurate with that execution function. But that super profit or super loss, so to speak, after that routine return has been given to the Indian entity, should not belong to India, because the key entrepreneurial decision which created that risk was never in that Indian company to begin with. So these are newer and newer models that large MNCs are trying to put in place, and they are not entirely away from the arm's length standard. So control over risk essentially means two things. One is that the entity which is allocated the risk should be the entity that has the functions which involve taking decisions that create the risk to begin with, and that entity should have functions which manage the risk. Okay, and if that entity has these two things, creation of risk and management of risk, those two functions or those two decisions, then obviously through contract this will get allocated to that entity. The other test is the financial capacity to assume the risk. Now what does that mean? Financial capacity to assume that risk means that if that risk were to really materialize, then that company needs to have the balance sheet size to absorb that risk. Okay, so very often in international tax you will see consultants sometimes recommending exotic structures to clients where they say that why don't you set up this IP holding company in Bermuda, and all that company does is just owns IP. But the real question is that what is the function that it has in that company because of which it should deserve the ownership of IP. And there are functions associated with ownership of IP also. Functions that create IP in the first place and functions which manage or protect the IP in the second place. There was a very famous ruling in transfer pricing, which it's not an Indian ruling, it was a ruling in the case of Sherwin-Williams Paints, where Sherwin-Williams, the paints company, it tried to migrate certain intellectual property from the state of New York to the state of Delaware. And their IP transfer was challenged by the IRS. If you read that ruling, the IRS, the court, the New York Court of Appeals has given elaborate principles on what kind of substance is expected from an IP holding company, for example. Okay, so again, I think if you see the gist of what the ruling is trying to say, it goes into these fundamental principles that the entity which is allocated the IP holding risk, for example, needs to have the relevant decisions which create the IP risk and which, and the financial wherewithal to bear that risk. In the Indian context also, I'll give you a parallel. There was Circular 6 issued by the CBDT recently on contract R&D, transfer pricing treatment of contract R&D service providers. Now there, the big dispute that is happening in India is that the tax authorities are challenging the cost plus method of rewarding a contract R&D service provider. And they are saying that the contract R&D service provider is adding or creating significant value, and therefore the method for rewarding a contract R&D service provider cannot be cost plus. In fact, the Indian company should be rewarded with a percentage of profit created from the sales of the products which are commercialized. And that is what the Indian tax authorities were trying to do in assessments. And they did some large assessments in some cases. And then the CBDT came up with this circular. And what the CBDT has said in that circular is pretty much aligned to this principle. They said that in a contract R&D context, if the taxpayer can show that the critical control functions are residing outside of India. Control functions in an R&D context means which product to do R&D on. So the foreign company needs to have a product committee, for example, which will undertake feasibility of different markets to see which products have a demand in a given market. And then based on that, they decide that, okay, this is a product that we need to develop. That's a significant function. So the decision to develop certain products is a significant function. Having taken that decision, the decision to initiate R&D is again a significant function. The decision to monitor the progress of R&D and at an appropriate state to take a decision that this R&D is not going anywhere, we should abort this R&D. That's also a significant control function. So CBDT said that if you can show that these decisions are residing outside of India, then the Indian entity which is performing contract R&D, it will be regarded as a contract R&D service provider which bears insignificant risk, and therefore the cost plus method of rewarding that entity will be respected. So the point here is that contract R&D inherently is very risky. It is inherently a very complex activity, and sometimes if you see the academic qualifications of scientists who work on R&D, you will see that many of those people might be PhDs. But just because you employ extremely highly qualified people to perform that work, and just because the work is inherently complex, that does not automatically mean in transfer pricing that value is created over there. Value is created in a legal entity which has the significant people functions that create the risk and which manage the risk. Okay, and that's where these two things come into play. So this is what OECD has also echoed in a business restructuring transactions, that whenever you are shifting risks across countries, if the allocation of risk is consistent with the economic substance of the arrangement, in other words, you are reallocating risk to entities which have the financial wherewithal to bear that risk, or which has the decision making which create those risks, then that risk allocation will be respected and not challenged. That's the principle. Now, what are the consequences therefore of risk allocation? It obviously means that the entity which bears the risk will also bear the costs of managing the risk. Now when I say managing the risk, it does not necessarily mean that that entity has to undertake functions to manage the risk itself. They can manage the risk through an outsourced service provider as well, like an insurance company. So you can have the parent company buy global insurance to bear certain risk. So that's a situation where you are not yourself undertaking the function to manage the risk, but you are allocating that function to somebody else. You can even appoint a third-party service provider who operates at your behest and undertakes control functions on a day-to-day basis. So let's take an example. Today, with Singapore emerging as a preferred hub destination in Asia Pacific, so Singapore has favorable laws where they incentivize MNCs to set up regional headquarters in that country. So you will see that lots of multinationals now have their regional headquarters located in places like Singapore, right? So when that happens, if you draw up the organogram of the Singapore entity, you will often see lots of decision makers sitting there. The entire organizational hierarchy will be residing in Singapore, and they will actually take most of the decisions relating to the markets within Singapore.